Hello, it's Robert Miner with Dynamic Traders Group with our weekly video for our YouTube and Twitter and Traders News subscribers and members. Here's where I do about a 10-minute video. I highlight one or two markets that have the potential high probability trade in the coming week, and I teach you all about the technicals on how we arrive at that trading decision. So whether you trade the market we talk about each week, here is you're going to learn something about how to make trading decisions for any market and any time frame, no matter what you trade. This is where we teach you how you integrate practical Elliott Wave, fib, time and price, and multiple time frame momentum strategies to identify trade setups with a high probability outcome. And if you like what you learn here, check out our DT reports, where we do a couple extensive videos every week with daily updates, complete information, trade strategies for stock indexes, gold, silver, the GDX, euro, dollar, Bitcoin and Ethereum, bonds, notes, crude, soybeans, and more. And please join us at the DT Traders News, also at dynamictraders.com. Choose the Traders News tabs, because we have additional trade alerts and videos on the Traders News section than what we have for Twitter and for YouTube. So sign up for that. We don't ask for any charge card. We just need your email so we can alert you to when a new update is placed in the Traders News area. Okay, let's get started. We're going to take a look at bonds and notes and yields this week, because we're at a very interesting position, and I think a significant trade opportunity in the days ahead. And I'll explain to you exactly why I think that. So this is a weekly chart of the 10-year yield, and of course it's of yield, so it's inversely of what we would look at if we were looking at bond data or notes data. But I think the yield chart is the most revealing. Then we'll go to the bonds and notes, and we'll look at specific trade setups that I think we're going to have before the end of this coming week. And whether you trade the futures or options or ETFs, you want to take advantage of this information. So here's the weekly yield, really beginning from the March 2020 low, where we had that just significant crash in yields almost down to zero, and then we've been working our way higher since then. Well, I don't think it takes any real expert on whether it's technical or fundamental analysis to realize that more than likely we're on an upward trend in interest rates. I mean, we've hit almost zero, and we don't need to look at a chart that say that more than likely in the months and years ahead interest rates are going to ratchet up. But let's take a look at an immediate position, which would be an immediate trade opportunity. So coming up off of that March 2020 low, this is in Elliott Wave terms, just a beautiful 1, 2, 3, and potentially a wave 4 in early August. Now, what's significant about that low, it was made just about to the tick to the 50% retracement. That's significant itself. Wave 4s usually retrace between 38 and 50% of the wave 3. And the wave 4 is usually around a 38% to a 62% time retracement of the wave 3. And early August was just a couple of bars, meaning a couple of weeks short of the 62% time retracement. So that low was made almost ideally in a position to complete a wave 4 correction. Now that's real significant, because what follows a correction will a resumption of the trend to a new extreme. In other words, to a new extreme beyond the wave 3. So we're going to work our way into here real soon, where we're in a really high probability immediate potential for trade opportunity in the next few days. So coming off the August low, again, it looks like a little 5-wave advance. That's a wave A. And what's significant is the last few weeks is almost an ideal ABC correction. So probably a wave 2. If that's the case, this December 3rd low is at the extreme of where a correction should be before the bull trend continues. Now, we're just one weekly bar. In fact, it was an inside week last week away from that low. And so if this were correct, it would mean, now this is yields, bonds and notes we'll look at in a minute, but they're in an immediate position within days of continuing their decline, yields continuing their advance. Let's take a look at the daily data and yields, then we'll get to the futures data. So here I'm just showing coming off of that August low. This is an alternative possibility pattern-wise, and that is we had the wave 3 in March of this year, and then this, instead of a 4, would be an A. This advanced into October, a B, and then this ABC correction, a C, and then we would then possibly have a D and an E before we continued to a new high. But what's significant here, if this sort of pattern unfolded in the weeks ahead, meaning we call this a contracting triangle, by the way, where we have higher lows and lower highs, and they come into a contracting triangle, and then they have a really sharp advance once it's complete. The significance here is if this alternative is what is going to unfold, it is a possibility, again, the market, the yield should not decline below the December 3rd low. So this is what we call in Elliott Wave terms the alternate wave count. It's a good possibility. The beauty of these two wave counts is they both indicate that yield should not decline below the December 3rd low. So we really want to be on the alert for a continuation of this trend. Now, whether it's immediately going to continue and do a new high in the weeks ahead, or we're going to meander around for several weeks, maybe even a few months before it continues, either way, this is the key point right here, the December low. Now let's take a look at the futures continuous data. Real quickly, before we look at the specific trade setup that should manifest itself within the next few days in bonds and notes, just a really quick reminder, please check out our Traders News. Go to dynamictraders.com, join Traders News, get additional updates, additional trade alerts if you're a member of our Traders News. So it's absolutely free. We don't need anything other than your email address so we can let you know when we have a new update. Also, please subscribe to our YouTube channel here so you get notified when we put new YouTube videos up, and also hit the like button if you think this is useful. Okay, let's get at it and develop a specific trade strategy, hopefully with a very high probability trade coming up in the next few days. So this is the futures continuous data. It looks just the opposite of what we're just looking at on yields. And here's what's significant. The weekly momentums made weekly dual look back bear reversals last week. That's pretty significant. That usually coincides with a weekly price reversal as well. So more than likely, bonds as well as notes have completed a weekly high and will be sideways to down for several weeks. And if that's the case, it's just the beginning of this next section of the bear trend over a few weeks. Of course, we have a Fed announcement next week. We'll take a look at that in a minute. But this is what's significant on the weekly data, the weekly bond data. Let's go to the daily data and look at the specific trade setup in the days ahead. And once again, if you don't trade bonds or notes, you don't have any interest in it, use this information, what you're learning, to identify trades in other markets and other time frames. But one of the reasons that this is fairly significant, even if you don't trade bonds or notes, is that most people look at interest rates and interest rate trends. They use it for some intermarket analysis. They use it for their own lending and borrowing programs that they have. So this is fairly significant if this is indeed a very significant low that was made in yields a couple of weeks ago, a fairly significant high in bonds a couple of weeks ago. So coming into the December 3rd high, just a beautiful ABC correction. The high was made right around the 100% alternate price projection of what I got labeled the wave A, and just a little above the channel line. ABC Zigzags, very typically the wave C is made right along the parallel channel line, or very close to it at least. And then bonds turned around and they've closed well into the closing range of what I got labeled the wave A, and that's indicating that more than likely this ABC correction is complete. And of course, given that the weekly momentums are dual look back bearish, that also indicates that that's the case. So here's the daily momentum, made a bull reversal on Friday. That's usually followed by 3 to 5 days sideways to up. The next daily momentum bear reversal, likely by the end of this coming week, will be a dual time frame setup to continue the weekly bearish trend. So again, whether you trade the futures or you trade options or you trade ETFs, there's bull and bear interest rate ETFs. You can take advantage of this next reversal and very high probability position then to continue a weekly bear trend. And you can do it with minimal capital exposure, and that's what trading is all about. We're not right every time. The technicals don't always reveal exactly where the reversals are and the trend of the market. So the whole idea is we identify a trade opportunity with minimal and acceptable capital exposure. And of course, we got the Fed announcement on Wednesday. So I suspect by the end of the week, we're going to make that bear reversal. Going to be a great setup on the short side with minimal capital exposure if we're wrong, and the possibility of a fairly significant decline. And again, on those Elliott Wave counts, they're both indicating that this December high shouldn't be exceeded. What if it's exceeded next? What if it is exceeded next week? Well, then we got to take another look. It would void that specific trade setup. So again, we identify the trade setup, we identify what voids that setup, we identify what confirms that setup, and then we identify the very specific entry strategy, the price, and where the stop is. So we're not just looking in general terms that, well, the market ought to be up, market ought to be down over such and such a period of time. When it gets into that position, we then identify specific go long, go short, and here's where your stop ought to be. Well, that's it for today. I hope you'll join us. You'll check out our DT Traders News on our dynamictraders.com website. Join us there, and I'm always open to comments, suggestions, and all that sort of thing related, if they're directly related to the videos. Everybody take care, stay safe. Be back with you next week.